Everyone, today we are going to discuss about broader asset avenues available for personal investments. So let's begin. Asset can be classified into two categories. First is financial assets, then comes non-financial assets. Financial asset is an asset in which you get the contractual right to receive cash in future, but that is not the case with non-financial assets. Financial asset can be classified for the investment categorization. It may be in equity, it may be bond investment, or it may be an liquid or investment in cash, whereas the non-financial assets broadly classified into say gold and real estate. So let's first discuss about the non-financial asset, and that too to begin with gold. So the prices of gold is majorly derived with the condition of dollar. If the dollar is going up, or say the dollar index is strong, the price of gold are expected to come down in future, or they are going to come down. Or say likewise the global interest rates, when they are say they are going down, then price of gold will go up, or the inverse relation stand truth. So gold is a substitute of a financial asset. It's considered as a safe haven. When the financial assets they are not giving the true value or the true return, the investors they will turn to gold. They will consider gold as a safe haven. Beside these global scenarios, that is the dollar, global interest rates, the geopolitical situations, or the wherever there is a turmoil time in the geoeconomic or geopolitical scenario, the price of gold tend to go up. Besides that, some local market premium, say in the Diwali season, so the local bullion premium may be added, so that will affect the price of gold. Or say the taxes, the IGST is there, say 3% tax is there. So based on those local scenarios, the price is tweaked to some extent, but majorly the price of gold is determined by the global market scenario, that too considering it with the dollar or global interest rates or geopolitical tension. So hope, considering these situations, you will be able to take the decision whether to invest in gold or not. You may also see the past historical trend, and what may be the future economic outlook. Based on that, the decision may be taken. Second comes the real estate. Real estate is more of a long term and illiquid investment. If you tend to invest in some liquid asset which may be traded in the secondary market without much of the compliance, then real estate may not be considered as a good investment option. So the unlike gold, which is majorly determined or derived, the value is derived through various geo global issues, real estate is simply a play of local market. You need to see the potential of that place, what are the other investment avenues available there, or real estate positions there, the placement, all these things they are taken into account while investing in real estate. So according the decision may be taken, it's more of a long term nature of investment. Now here comes the much debatable issue, the among the financial asset, which are better avenues. So these are equity, bonds, and cash. Mainly three broader categories I have considered for this video. Now equity, you may also include equity mutual fund also. Bond, you include all the debt securities, CPCD, debentures, and even your mutual fund, debt mutual fund. And cash is simply a cash, or the demand for a bank loan is also a cash only, because when you demand for a loan, you and get up some cash. So considering the broader spectrum, you need to further assess as per your personal choice. So as per JM Keynes, it is always bond versus cash. So let's begin with the cash first. So cash has three motives to hold. First is transaction motive, second is precautionary motive, and third one is speculative motive. Transactive and speculative motives have nothing to do with the interest rates. They are simply a play of your GDP growth. With the growth in the GDP, there will be more transactions. There may be more precautionary need to hold the cash. So they have nothing to do with the fluctuation in the interest rate. It's the speculative nature of holding the cash that needs to be adjusted with the changes in interest rates. So this is what the JM Keynes told us. You know that there is an inverse relationship between the bond and yield. I have created a video. If you want to know the concept behind it, that why there is an inverse relation, you go by that particular video. So coming back to the James Keynes theory, James Keynes gave it this theory considering the expectations of yield in future. He told that if the yields are going to go up, expected to go up in the future, so what will happen is, since there is an inverse relationship between the bond and yield, the price of bond will go down in future. Means in future you will purchase that bond. So what will be the current situation? It will be the opposite to it. Means you will sell that bond. You will sell that bond means you will have more holding of cash, or the demand for cash will go up in the current situation or in the present situation. Likewise, the demand for bank loan will also go up. On the contrary, when the yields are going to go down, means the price of bond will go up in the future, means you will purchase the bond today so that you will be able to sell it in future and have some capital gain. Since you are going to purchase the bond, the demand for cash or loan will go down currently. So this is the simple mathematics or simple equation, that it's a bond vis-a-vis cash decision which you take into account. But there comes another player of financial assets, that is equity. It's equity versus bond now. In recent times we have seen that equity market was bullish and bond market was bearish. There is an adage that says that when bonds and equity disagree, you need to trust the bond, because both are financial assets and both are to a great extent affected by the interest rates. So in equity market, yes, of course, there are foreign institutional investors, they are also there. So here comes an interest in this particular equation, that how with the yield as a nominal anchor to make some choices in investments, how you are going to deal with it. So as we just go by these two equations, we came to know then when the yields are going to go up, the demand for cash or the present holding of cash or bank loan will be more, or the demand for bank loan will be more, or cash holding will be more. So what you do is you invest those cash in equity. Don't keep it idle, invest it in equity. And in future, you know that yields they are going to go down, then you need to sell your equity. It's just the opposite situation, right? And you need to purchase bond, because you know you purchase bond when yields are going to expected to go down, you purchase the bond, and when they actually go down or bottoms out, you need to sell those bonds, so that you end up having some gain. So let's understand this virtuous cycle in step by step method. Then when the yields are expected to go up, you need to invest in equity. When the yields peaked out, you sell those equities. When the yield peak out, it means they are expected to go down now. Means you sell the equity and invest or purchase in bonds, because once they go down, you will be able to sell them. Once the yield bottoms down, means again they are expected to go up. Once the yield bottoms down, you need to sell bonds, book your profit. You have now holding in cash, now you should investment in equities. It is same as yields are expected to go up. Yield bottoms down is same as yields expected to go up now. So this is the investment cycle which you need to follow. These are the investment cycles in the current. If you consider three types of financial asset, that is equity, bond and cash, then this is how you need to rotate it. One more point, when it comes to interest rate parity, you know that yields or interest when go up, you know the rupee appreciate in a short term period, but in longer term tenure, if you talk about that, the interest rate parity is there. So say if in India current rate of dollar is say 80, and interest rate for India is say 20%. example, it is just an example, and interest rate in US is say 10%. So in future it is going to be say 85, so rupee is going to depreciate only. So with the increase in interest rates, rupee there is, it is going to depreciate only in future, but it is only for the short term that rupee appreciates, and the foreign institutional investor for that short term invest in equity. So say as of now 75 lakh crore is, that is the domestic investors, and 75 lakh crore are the almost like this, there are the foreign institutional investors. So it's not only um, the domestic play here. This virtuous cycle is not only a play of a domestic player, you have yield affecting those foreign institutional investors also. Recently financial stability report that the US yields are going up, so it is more of a matter of worry for India. So we know that as per interest rate parity, when the US interest rates are going up in longer term, it is going to give strength to the money or rupee. But in short term, you know, the foreign institutions, they will pull their money out of India and they will invest in US or some developed economies, and they will pull their money from emerging economies like India. So yield there, if it is going up from the equity market perspective, it is a good sign. So that's why when the yields are expected to go up, you should invest, and when they peak out, you should sell the equity. So from both, from James Keynes perspective, from the interest rate parity perspective, I have told you that what should be an virtuous investment cycle look like considering the current economic scenarios. One more point, we know that I told you this equation, this says that this James Keynes told that when yields are going to go down, this bonds will, the price of bond will go up in future. The yields are expected to come down, the price of bond will go up in the future. This is the futuristic scenario. So present, at present what will you will do is you will invest in bond at a higher yield. At a higher yield you will invest, and when the yield goes down you will, so as an higher yield, as an investors you are going to invest, but whether the issuer will issue, whether the issuer will issue the bond at a higher yield, because it will result in higher cost of borrowing for the issuer. So again, there is a twist in it. You need to see whether it's a seller's market or buyer's market. The bond or the debenture is seller's market or buyer's market. Your decision will depend on it. What is the seller's market? When the demand exceeds the supply, it is considered to be a seller's market, and on the contrary, when demand is less than supply, it is buyer's market. So again, it may be sellers and buyers market both. Say it's a AAA rated company, so I will say it's a seller's market because demand for such bond is very higher. So in this case, the issuer will not issue the bond at a higher yield. When it is a buyer market, then of course you should try to purchase the bond or invest with the bond which are at higher yield or providing the higher coupon rate now, so that when in future the bond yield go down, you will be able to sell it in the secondary market and book some profit. So if it is seller's market, it is highly likely that you need only to hold your this in cash. The cash holding will be there only, because you will not be able you will not be able to invest in bond in that type of situation. You may look for the investment in equity, but again the market volatility is there. So equity market is not simply driven by the foreign institutional this yield thing or foreign institutional, there are so many, say tariff issues are there. So foreign institutional investors, they are very sensitive to such geopolitical tension. Some war is going on, some Trump this tariff decisions are taken. So in volatile times, such equations theory, the 1 + 1 = 2, them that may not hold good. So your decision should be taken accordingly. I hope this lecture is going to This lecture is going to help you in solving your doubts, and you will be able to take a decision considering the various macroeconomic factors and your personal investment choice back in your mind while taking the decision. Thank you.